Welcome to another episode of AKA Ask Kevin Anything. Our question today comes from downtown Bowie, Maryland, and it concerns converting a traditional IRA to a Roth IRA. Our listener's question is, if I convert my traditional IRA to a Roth IRA, would that conversion be subject to the 3.8% net investment income tax? This is a great question from someone who obviously understands a lot about taxes. But before addressing the specifics of this question, let's consider the broader question first. Should you even convert your traditional IRA to a Roth IRA? Here are our top 3 answers. Number 3, no, you should not. Number 2, yes, you should. And our number 1 and correct answer is, it depends on the individual situation. There are so many variables that play into the situation that we have put together a checklist of 18 considerations for the Roth IRA conversion. You can download it by clicking on the link below. However, if there was just one overarching question, it would have to be, do you expect to pay the taxes on the conversion from assets that are outside of your retirement plans? In general, paying the taxes on the conversion with retirement funds is not a good idea, especially if you're younger than 59 and a half. Let me explain. If you're in a combined marginal federal and state tax bracket of 30% and you're younger than 59 and a half at the time of conversion, your retirement assets will decrease by a whooping 40% of the converted amount. That comes from a combined marginal federal and state tax bracket of 30% of the converted amount, plus an additional penalty of 10% for being under 59 and a half. But there are exceptions to every rule, even to that one that seems very straightforward and absolute. So let's go back to the original question, which is, are Roth conversions subject to the net investment income tax? You may be wondering, what is this net investment income tax? This tax was born as a result of the Affordable Care Act. It is an additional federal tax on one's investment income. Investment income is usually defined as interest, dividend income, and capital gains. It is levied on investment income once a taxpayer's modified adjusted gross income reaches a certain level. For joint taxpayers, the modified adjusted gross income is $250,000, and for individuals is $200,000. Now, retirement income is not subject to the 3.8% net investment income tax. So the answer is that Roth conversions are not subject to net investment income tax. But before we strike up the band, whoa, I said before we strike up the band. I'm glad I was able to stop them. They usually have a 3-song minimum. As I was saying, while the Roth conversions is not subject to net investment income tax, the conversion could indirectly cause the taxpayer to be subject to net investment income tax by increasing the modified adjusted gross income over the thresholds I mentioned before, thus triggering the net investment income tax. If you are already subject to net investment income tax, the Roth conversion could increase the net investment income tax. Please take a moment to click on the link below and download our considerations for taxable Roth conversions. If you have a question and you'd like to also help out our local food pantry, please submit your question on our website. We make a $100 donation to the food pantry for every question used on this segment. In the meantime, like us on Facebook, follow us on LinkedIn, or subscribe to our YouTube channel.